It's no secret that ignorance about money matters comes with consequences. In fact, 40% of the world's population struggles with understanding finances. And this becomes even more challenging when we look at individual countries. In developing nations, this percentage jumps to nearly 80%. According to a report by the National Financial Educators Council, in 2022, 15% of adults lost at least $10,000 due to their lack of financial knowledge. But it looks like you are in luck. If you want to avoid suffering from such losses, watch this video, where we'll share 15 ways that you can use to increase your financial IQ. Before we dive in, make sure to click that like and subscribe button and turn on notifications so you can be the first to know when new personal finance content comes out. The Finance Matrix. First and foremost, it's essential to understand the basics of finance. This includes how the banking system works and how money moves through the economy. Understanding the banking system and money's inner workings is key to boosting your financial know-how. It involves grasping important concepts like interest rates, inflation, and credit. With this knowledge, you can make smarter decisions about saving, investing, and managing risks, which ultimately helps you grow your wealth and avoid potential pitfalls. Learning about loans and borrowing is also crucial. It helps you use debt wisely and choose the best credit products with favorable terms. Additionally, understanding the banking system isn't just about personal finance. It also gives you insight into broader economic trends known as macroeconomics. Recognizing how banks and monetary policies influence the economy enables you to adjust your financial strategy as needed. During economic ups and downs, financially savvy individuals seize opportunities to build wealth. That's why investing time in understanding finance is an investment in yourself and your financial future. Having a solid grasp of finance equips you to make informed decisions, manage risks effectively, and create wealth over time. Master the Rule of 72. Another important concept to master is the Rule of 72. This rule helps you estimate how long it will take for your investment to double in value based on its annual interest rate. It's a handy tool that demonstrates the power of compound interest and allows you to compare different investment options quickly. Here's how it works. Simply divide 72 by the annual interest rate expressed as a percentage. The result gives you an approximation of the number of years it'll take for your investment to double. For example, with a 6% annual interest rate, your investment is likely to double in about 12 years. Keep in mind that the Rule of 72 is an estimation and may not always be perfectly accurate, especially when considering additional factors like fees and taxes. However, it's still a valuable shortcut for understanding how investments grow over time. By mastering the Rule of 72, you'll gain insight into how interest rates affect your investments. This can help you make smarter investment decisions by quickly comparing potential growth across different options. Decode behavioral finance. Behavioral finance is a fascinating field that combines psychology and finance to understand how human emotions and biases impact financial decisions. Its main goal is to explain why people often make irrational choices, even when they have all the necessary information. Concepts in behavioral finance include overconfidence. People tend to overestimate their abilities or the accuracy of their beliefs, leading to taking excessive risks or making poor investment decisions. Confirmation bias. This is the tendency to seek out information that confirms existing beliefs, while ignoring conflicting evidence, which can narrow one's perspective. Loss aversion. Individuals feel the pain of losses more intensely than the satisfaction of gains, causing them to hold on to losing investments for too long or sell winning ones too soon. Anchoring. This bias involves relying too heavily on initial information when making decisions, such as valuing assets based on historical prices rather than their true worth. Herd mentality. People often follow the actions or opinions of others, even if they contradict their own beliefs, leading to irrational market trends. Mental accounting. This bias involves treating money differently based on its source or intended use, resulting in inconsistent financial behavior. Recency bias. People tend to give more weight to recent events or information when making decisions, sometimes overreacting to short-term market fluctuations. To overcome these biases, consider the following strategies. Increase self-awareness. Reflect on your decision-making processes and recognize when emotions or biases might be influencing your choices. Use the 72-hour rule. For non-essential purchases or investment decisions, wait 72 hours before taking action to avoid impulsive decisions driven by fear of missing out. Implement disciplined investment strategies. Use methods like dollar-cost averaging or setting stop-loss orders to minimize emotional influences on investment decisions. Focus on the long term. Prioritize your long-term financial goals and avoid reacting impulsively to short-term market fluctuations. Monitor progress. Regularly review your investment portfolio and financial plan to ensure they align with your objectives and identify any biases that may have influenced your decisions. By understanding behavioral finance and its impact on financial decisions, you can develop better habits and make more rational choices with your money. Implement zero-based budgeting. Implementing zero-based budgeting is a smart financial strategy that ensures every dollar you earn is allocated towards specific expenses, savings, or investments. Unlike traditional budgeting methods, which adjust previous budgets, zero-based budgeting starts fresh each time. To get started, list all of your sources of monthly income, including your salary, any side hustles, or passive income. Next, make a detailed list of all your expenses, categorizing them into fixed costs like rent and utilities, and variable costs like groceries and entertainment. Finally, allocate the remaining funds to savings, investments, or debt repayment, ensuring every dollar has a purpose. Zero-based budgeting helps you become more mindful of your spending habits and gives you greater control over your finances. By regularly reviewing and adjusting your budget, you can stay on track towards your financial goals and develop better money management habits over time. Study case studies of financial successes and failures. Studying real-life examples of financial successes and failures can provide valuable insights into the strategies, decision-making processes, and external factors that lead to both positive and negative outcomes. By examining these case studies, you can learn to recognize patterns, gain wisdom from others' experiences, and apply these lessons to your own financial journey. Successful case studies, such as Warren Buffett's investment strategies or the growth of companies like Apple and Amazon, offer valuable lessons in value investing, effective business management, and adapting to changing market trends. Analyzing these successes can help you understand the importance of long-term planning and the role of innovation in building wealth. On the other hand, examining financial failures such as the collapse of Enron or the 2008 financial crisis highlights the consequences of unethical behavior, excessive risk-taking, and following the crowd. By understanding the mistakes that led to these failures, you can develop a more cautious and comprehensive approach to managing your finances, better equipped to navigate potential challenges and avoid pitfalls. Learn to read financial news critically. Learning to critically read financial news is essential for making informed decisions in today's fast-paced media environment. It's crucial to sift through the sensationalized headlines and identify valuable insights amidst the noise. Start by evaluating the credibility and potential biases of the news source. Consider factors like the author's interests, advertising pressures, or political affiliations that may influence the information presented. Cross-referencing multiple sources can provide a more balanced perspective and help you recognize alternative viewpoints. Focus on articles that offer well-researched, data-driven analysis supported by evidence, rather than relying on anecdotes or opinions. Be cautious of sensational headlines designed to grab attention but lacking substance. By improving your ability to critically assess financial news, you can avoid making impulsive decisions based on unreliable or biased information. Always prioritize following the money to find accurate answers and make sound financial choices. Challenge yourself with financial experiments. Engaging in financial experiments can be a great way to test and improve your financial skills. These experiments can involve setting short-term goals, trying out new financial strategies, or exploring different investment opportunities. By stepping out of your comfort zone, you can gain valuable insights and enhance your financial knowledge. When embarking on financial experiments, it's essential to maintain a learning mindset. Reflect on your successes and failures, stay open to change, and track your progress. By documenting your experiences, you can identify patterns and lessons that will inform your future choices. Another useful practice is analyzing the financials of your favorite brands. This involves examining their financial statements, revenue streams, and profitability. Understanding the financial health of companies you admire can provide valuable insights into their operations and help you make more informed investment decisions. Analyze your favorite brand's financials. Start by studying the company's income statement, balance sheet, and cash flow statement. These documents offer insights into the company's financial health and performance over time. Not only that, but also pay attention to metrics like revenue growth, profit margins, debt levels, and liquidity ratios. Comparing these numbers to industry benchmarks or competitors' data can reveal the company's strengths and weaknesses. Additionally, listening to earnings calls and reading annual reports can provide deeper insights into the company's strategic vision, management outlook, and potential risks or opportunities. Analyzing your favorite brand's financials not only enhances your financial knowledge, but also helps you make better informed decisions as both a consumer and an investor. Follow influential financial podcasts. Following influential financial podcasts is a fantastic way to boost your financial knowledge. These podcasts offer valuable insights and expert advice on personal finance, investing, and wealth management. Podcasts are convenient and accessible, allowing you to listen while commuting, working out, or during your free time. They help you stay informed about market trends, investment strategies, and practical financial tips. Many top financial podcasts feature interviews with successful entrepreneurs, investors, and financial experts, offering a diverse range of perspectives and guidance. By listening to these discussions, you can learn valuable lessons from others' experiences and apply them to your own financial journey. Additionally, financial podcasts simplify complex concepts, making it easier for listeners to understand and implement their knowledge in their daily lives. To maximize the benefits of financial podcasts, choose shows that align with your interests and goals. Look for podcasts covering a range of topics such as personal finance, investing, entrepreneurship, or financial independence. And if you're looking for a starting point, consider checking out podcasts by Naval Ravikant. His principles for building and maintaining wealth are highly regarded for their logic and effectiveness. Read influential personal finance books. Reading influential personal finance books is a great way to boost your financial knowledge. Personal finance books cover various topics such as budgeting, saving, investing, debt management, and wealth building. They often include relatable stories, case studies, and real-life examples that make complex financial concepts easier to understand. To make the most of personal finance books, consider taking notes or creating summaries of key takeaways. Then, apply these lessons to your own financial situation in a way that aligns with your goals and circumstances. Utilize gamified learning apps. Gamified learning apps are a fun and interactive way to learn about finance. They incorporate game-like elements and rewards into the educational experience, making it engaging and motivating. Popular gamified learning apps like WellSpent or Investopedia Stock Simulator focus on stock market investing. Users can create virtual portfolios, simulate trading, and compete with others in a risk-free environment. These apps help users learn about investment strategies, analyze company finances, and understand market dynamics while earning rewards. There are also gamified apps designed to teach budgeting, saving, and personal finance management. These apps use visuals, quizzes, and progress tracking to help users develop positive financial habits and achieve their goals. Set up a financial vision board and utilize goal-based investing. Creating a financial vision board is a visual representation of your financial goals and dreams. You gather images, quotes, or symbols that reflect your desired financial future and organize them on a tangible or digital board. This board serves as a constant reminder of your aspirations, guiding you towards decisions that align with your goals. Goal-based investing is a strategic approach where you tailor your investments to meet specific financial objectives. Instead of solely focusing on maximizing returns, you prioritize reaching milestones such as buying a house, funding education, or planning for retirement. By identifying and prioritizing these goals, you can customize your investment strategy based on factors like time horizon, risk tolerance, and required capital. The vision board inspires and motivates you, while goal-based investing provides a clear roadmap to reach your objectives. Experiment with dollar-cost averaging. Experimenting with dollar-cost averaging, or DCA, is a smart investment strategy that involves investing a fixed amount of money at regular intervals, regardless of market conditions. This helps reduce the impact of market volatility and avoids the risk of making impulsive decisions based on short-term fluctuations. DCA allows investors to benefit from both market upswings and downturns. By consistently investing over time, they can purchase more shares when prices are low, and fewer shares when prices are high. This strategy also helps overcome psychological barriers to investing, as it automates the investment process and encourages a long-term perspective. To implement DCA, investors should determine the fixed amount they want to invest and the frequency of those investments. They should then choose an investment vehicle, such as an index fund or exchange-traded fund, that aligns with their risk tolerance and long-term financial goals. Remember, splitting investments across time is a prudent way to invest, rather than going all in at once. This promotes financial discipline and patience, fostering good saving and investing habits. Automate your finances. Automating your finances involves setting up systems and tools to manage and simplify different aspects of your financial life, like saving, investing, and paying bills with minimal manual effort. By automating these processes, you can save time, reduce the risk of errors, and stay on track with your financial goals. To start automating your finances, set up automatic transfers from your checking account to your savings account or investment accounts at regular intervals, such as monthly or bi-weekly. This pay-yourself-first approach ensures consistent saving and investing, helping you build wealth over time. Additionally, consider automating your bill payments by scheduling recurring payments through your bank or directly with your service providers. This not only saves time, but also helps avoid late fees and maintains a good credit score. Study the principles of financial independence and retire early. Studying the principles of financial independence, retire early, is a lifestyle and personal financial approach focused on aggressive saving and investing to achieve financial freedom at a young age. The main idea is to gain enough assets to generate sustainable income that covers living expenses, allowing early retirement without relying on traditional employment. This is often done by maintaining a high savings rate, usually around 50% or more of one's income, and investing in low-cost, diversified portfolios to maximize returns. FIRE principles emphasize frugality, intentional living, and long-term financial planning. Adherents often cut out discretionary expenses, optimize tax strategies, and prioritize investments that generate passive income, such as index funds, rental properties, or dividend stocks. So all you need to do is play smart, and you too can change the way you manage your finances in no time. Thank you for watching this video on ways to increase your financial IQ. If you enjoyed this, please give it a thumbs up and subscribe to our channel for more personal finance and investing related content. Here's to becoming rich and financially free.